Good morning and welcome to PAC's program, Three Legends and a Recession, a conversation on navigating the COVID recession when those who have been there before. We are excited to present this program to you this morning and are very grateful to Fairmount Partners, a founding leader of PAC, for their support and sponsorship. Three Legends and a Recession. The connection to our Enterprise Awards is on purpose, and this morning you're going to hear from three of our legends. But first, a little bit of a word to our Enterprise Awards program. It was scheduled for early May. We obviously postponed it, and we are going to produce it virtually on September 9th. There'll be communication coming out in the near future to share that date and the specifics. We'll celebrate a dozen of our top entrepreneurs in the region. Perhaps some of those people are participating here this morning. In terms of etiquette for this morning's webinar, attendees are muted and off camera. We have enabled the chat function for general comments or to communicate with the hosts. Please use the Q&A window for any questions. Again, the webinar is being recorded and we can share it with participants, and you can share it out to others. Let me start by introducing our moderator this morning, PAC board member and director of Fairmount Partners, Alan Bourne. Alan, welcome.
Thanks, Dean. Appreciate it. And thanks for joining us, everyone. So prior to COVID, we had seen a period of 11 straight years of economic growth. And because of that long period of expansion, many of today's business leaders have limited experience in managing the minefields of recession. So today it's my pleasure to welcome three business leaders, each winners of the PAC Legend Lifetime Achievement Award, who have successfully managed through prior recessions. So today we're going to talk a bit about past recessions and the lessons learned, as well as the current COVID recessions and what challenges and opportunities might lie ahead. So let me first introduce the panelists. Bob Keith is founder and managing partner of Nouveau Capital and TL Ventures, which raised more than $1.5 billion over 7 funds. Roseanne Rosenthal is president and CEO of Ben Franklin Technology Partners of Southeastern Pennsylvania, which has invested more than $200 million and launched more than 2,000 companies. And Howard Ross is a partner with LLR Partners, a private equity firm that has raised more than $3.5 billion across 5 funds. So welcome, everybody. Yeah. So let's start off with a little bit of historical perspective. So we've obviously been here before. Recessions are nothing new. In fact, we've been through 11 of them since 1945. And today we're going to talk about a couple in particular, the dot-com bubble and the Great Recession. And this one we'll get to in a little bit, although I will note, I don't know if you can see my pointer here, that based on GDP forecast for Q2, the GDP will be somewhere way down here. So we'll get to this one later. So to the dot-com bubble, it lasted 8 months, which was pretty short compared to other recessions. Peak unemployment hit about 6.3%, and GDP declined by 0.3%. It was driven by a collapse of technology stocks, a fall in business investment, and 9/11. The Great Recession, which many more of us remember, lasted from December 2007 through June 2009. Peak unemployment hit 10% and GDP declined by 5.1%. It was driven by a collapse of the housing bubble and a collapse of many of the U.S.'s largest banks, as well as the auto industry. So that's a little bit of background. So to kick off our discussion, Bob, Roseanne, Howard, it would be great to understand where you all were during these prior recessions and what your roles were.
So I can kick off, Alan. I was, for both of those recessions, I was in my current position as president and CEO of Ben Franklin. And our challenge was twofold, because as a mission-driven organization, we have to balance our work to continue to execute that mission, which is to advance the economy of our region through technology growth, while we're also managing the sustainability of our own organization. Also, in times of recession, as an economic development organization, our work is always to step into that breach. But we have to do that in a way that ensures the continuity of our organization while we're executing our mission.
Great. Howard and Bob?
You know, in the dot-com bubble, I mean, LLR was 2 years old, so we were trying to figure out what the hell we were doing. And we were never really focused on the internet type of company. We were much later stage, you know, more grounded or more bricks and mortar type businesses. So the dot-com bubble didn't really impact us too much. I mean, it slowed the economy down, so we were not as active as we normally are. The Great Recession, though, was a much bigger impact. And I'm sure we'll talk about it some more, but in both recessions until now, I've been working at LLR making investments. I will say that during the Great Recession, our level of investment activity was incredibly muted. We did one investment in 20 months, so you can get a sense of the impact there. But that's what I was doing.
So from my standpoint, the dot-com bubble was had a big impact because we were early stage investors, and I would say in hindsight, one of the mistakes we made through that period was deciding that we should we should stay with early stage investing, and that's why I cringe to hear Howard talk about the fact that they weren't doing internet deals. We continued to do early stage deals, obviously not so much internet. And frankly, we were spoiled by the success of internet capital, which was a screaming success, even in West Coast terms. We made a huge amount of money in that short period of time. And one of the other things that happened, just as an aside, and maybe of interest to some of you, is that it brought on the beginning of the, I won't say collapse of Safeguard, but Safeguard had been run by Pete Musser, who'd done a huge amount for this region from a standpoint of entrepreneurs. And Pete had put all of his eggs in the internet basket. And on top of that, he'd borrowed a lot of money personally. All this is public knowledge, so I'm not telling any secrets. And you know that so Safeguard never really recovered from all that, which is a loss for all of us, quite frankly.
Great. From my perspective, during the dot-com bubble, I was a young associate investment banker just out of MBA school, and I'm glad I graduated in 2000 as opposed to 2001. I can tell you that. And then in 2007, I was, I think, a vice president, and had a tremendous 2007 and had an outstanding 2008, all teed up. Unfortunately for me, it was Q4 loaded, so to see all those deals go away was brutal. But at any rate,
hey, Alan, just one other quick comment about the dot-com bubble. And Howard and many of the people on the phone, and Roseanne will remember this, but there used to be a group of investment banking firms like Montgomery Securities, Robbie Stevens, or whatever, and they would take these very relatively small but promising early stage tech companies public. And after the dot-com bubble, they basically disappeared, which was a real loss as far as I'm concerned, because even though the deals were speculative, it gave the public a chance to get into these deals and frankly some liquidity. So that was a big impact as far as I'm concerned.
Yeah, those are some great names, Bob, from the past. I remember those names well. You also could add H&Q, Hambrecht and Quist, and
Exactly.
Brown.
Yep, those are great
Those
names.
four firms were, and I would idolize those firms when I was in my prior career at Arthur Andersen.
Well, you know, from Ben Franklin's perspective, going into the dot-com bubble burst, since we're talking about that, we were in a good position because we had just come off of our most successful year vis-a-vis returns, because as a result of the euphoric environment that was going on then, a number of our IT companies were being acquired, we were being paid off. So we went into the bubble burst in a very good position, actually. There had been a lot of chatter and signs that, you know, speculation of when was this bubble going to burst. So we took our money off the table early, and it affected 1/3 of our portfolio. So we have a very diverse portfolio, not just IT. So as a result of it being 1/3 of our portfolio and a lot of those companies having retired their investment with Ben Franklin, it didn't impact us as much as the subsequent recession certainly did.
Interesting. So when you think about these two in particular, the dot-com bubble and the Great Recession, how would you characterize them, and how are they different from an operational and economic impact?
Yeah.
So go ahead, Roseanne.
Well, for us, as I mentioned, the dot-com bubble was shorter. Some of our companies certainly didn't make it, but others were doing well because they were acquired and raised dollars earlier. The Great Recession was a lot more severe. It was sudden. There hadn't been the same sort of indicators that everybody had been talking about. It affected the financial industry, so it really cut across all sectors and all of our companies. And because our success rises and falls really with the success of our companies, clearly we had to plan for a drop in revenue. And at the same time, the funding we received from the Commonwealth was virtually cut in half overnight. So we had to, as companies did, we had to redefine our revenue model. Our board under Bob Keith at that time and our staff really rallied, cut our expenses to the bone, prioritized our resources to support. We had almost 200 companies in our portfolio. So our priority had to be to support those companies because none of us had a clue as to how long this was going to last. We also set out to work with our partners across the state, including PACT, over the years then to bring alternatives to the Commonwealth so that we could attract more dollars to early stage investment. The dollars were not going to come from state budget. We also paid attention to what was going on at the federal level and worked with partners to develop an energy strategy that was then very current and brought over 130 million to the region. And then, we started to develop other co-investment partnerships to attract private capital to where it wouldn't naturally go. It impacted our companies across all industry sectors because there was a greater anxiety regarding the timing of how long this was going to last and the structure. You saw federal intervention to save certain industries in a highly charged election year. And then you saw ultimately, broad federal stimulus package for shovel-ready projects that were anything but shovel-ready, and then the resultant increase in government regulation of the financial industry that had a lot of unanticipated consequences in later years.
I mean, both events attempted to wring excesses out of the market. And I think that's what happens with these recessions. The bubble gets a little too thin and it bursts. The beauty of the internet or the dot-com bubble is that it was more limited in focus, I think, and it seemed to go quicker in my mind. Maybe it's just because of what we were doing had less of an impact. I mean, the Great Recession has the word great in front of it because it was a big friggin' deal, and it was broader, it was deeper. There was a lot of focus on liquidity and leverage. And a lot of that wasn't as relevant, perhaps, in the dot-com world. But in the Great Recession world, there was a tremendous amount of financial impact, and financially engineered businesses got into trouble. So, I mean, maybe closer, we're going to talk about COVID, but COVID may be a lot closer to the Great Recession than the dot-com thing. Go ahead. Bob will be more elucidating.
No, but I think that's a great distinction. But because I think, as both Howard and Roseanne have said, that Great Recession was, and when you think about, Lehman Brothers failing, banks, needing, very, very significant bailouts and so on. So liquidity in the marketplace was really an issue for small companies. And so those of us in the investing business had to be prepared with cash reserves to back our companies or not back them. And make some pretty hard choices along the way, which I think this has always been as a matter of choices. It's fascinating to me today that liquidity, at least in the world that I live in now, which is smaller than the one I used to live in, that getting access to funds, to some extent banks, although certainly more cautious than they were, but getting funding for companies is just, it hasn't declined very much. So if you have an interesting opportunity, I have a small company I invested in very early stage that just 2 weeks ago got a $3 million investment from a Boston VC firm. And they did it all through Zoom. They never met personally. And so I'm sure a lot of that's happening. And of course, the public markets will continue to be strong, and the IPO market's good.
Right. Thinking back to those days, Bob, you mentioned that you were having to make tough decisions about, do I support, do I not support? So how are you thinking about those decisions? And Howard, you and Roseanne as well. How are you thinking about those decisions? And what were some of the operational or strategic mistakes or challenges that you saw being made in the face of these recessions?
Well, I think it's a matter of, very candidly, experience. So some of these business models began to fall away under their own weight, meaning that the prospects for continued success and growth became fairly apparent. So one had to pick and choose among those. And that was, that's just where the experience came in. And I would say, in my case, in our case, we were, not great at that. We were not as good as maybe we should have been, because we had expanded the firm. We had a lot of people around, and so I think being disciplined in these kinds of environments and really looking very, very hard at what's going on either inside your own business or if you're investing in terms of the companies, and being skeptical about who's as Andy Grove said, only the paranoid survive.
Yeah, I mean, some of the operational issues, first of all, we tended to support every company because we were probably making fewer bets than Bob was making and Roseanne was making. And we didn't really want anything to fail. And that's one of the big problems or unsolvable questions in our world is, when do you just say no more money? Because you always have the money. Is when you say no to some company and management team you've supported. And it becomes very much, there's a human connection there that's hard to sever and just say no to. And we debate that every week, including in the last couple of weeks. I think looking at preserving liquidity and preserving optionality is critical. And you got to do what you got to do to create the liquidity and look at headcount and look at non-essential expenses. And those lessons haven't changed. And, one lesson that I've seen over and over again is you never cut deep enough. That's a hard thing to say, but we tend to think it's always going to get better tomorrow, and it often doesn't.
I think
That's
from our
interesting.
perspective, another thing that sort of error that we saw some of our companies making in both cases was sort of unwillingness to take the dollars that were being offered on the table in anticipation that there was a better valuation out there somewhere. In one case, they didn't realize the party was ending. In the other case, they didn't realize how long the distress was going to be lasting. So that was an error that some made. I think as folks have said, it really comes down to leadership, as we had to take a look through and do a triage of a lot of companies in our portfolio. Who were the CEOs that were able to make those hard decisions and had the strength and to really critically assess what was important to the company's survival and what wasn't, as opposed to being enamored with their original vision. I think being able to change that vision to reposition the company and capture what was possible to capture, and what was going to be happening at the end of whenever it was going to be ending, recognizing that their past assumptions were just that. They were past assumptions and really weren't relevant to going forward. And then, those who were able to retain their key talent and were able to explore partnerships that helped them to maintain or expand their offerings at the same time they were conserving resources, in addition to making the cuts that were necessary. Those were signs to us that we had good teams.
That's a great point, and you're moving into something that I wanted to get to next, which is what were the key factors that distinguished the companies that emerged stronger as opposed to those that didn't make it? And so what were the success factors of those that were able to retrench and get out of the recession both .com and the Great Recession stronger?
Well, Roseanne hit on the key topic. I mean, where you have strong managers who really understand their team and their business, those are bets always worth making. I think where you have recurring revenue streams, some predictability to future revenue, some visibility on future revenue, those tend to be bets you want to hang in with. A lot of it, and we're seeing this in COVID now too, a lot of it is industry specific. I mean, if you're in healthcare, I think in technology, those tend to be better bets than a lot of other bets that are out there. So I think and whether or not the company's truly offering something that's unique to the marketplace. The extent it's something differentiated, maybe has carved out a leadership in a particular niche within a market, good management and recurring revenues, that's a brew for a good support.
I think Roseanne made a really great point earlier here, which is the managers that have the experience and or the wisdom to take the money when it's offered. That is absolutely critical. I'm seeing that, even today where, some of the managers are, and some of them are thinking, I can wait this out, or I want a valuation that's, was higher than my last round. All those kinds of things that happen, particularly with overly optimistic or really brand new CEOs. And it's an incredible mistake in my estimation. And because they were spoiled, in my view, by this, I won't get on the soapbox, but this annual recurring revenue valuation model, which I used to run around the office here over the last several months, ranting and raving about, what a ridiculous model that is. It's a game of musical chairs as far as I'm concerned. So, my adage is, even back in the banking business, was take the money and run.
As my partner, Ira Lubert, said, or I like to say about Ira, and Bob will appreciate this more than anybody, Ira has made a fortune selling early.
Right.
That's your point, Bob.
Absolutely.
Yeah.
Absolutely.
Made a fortune selling early. Yep.
Interesting. Okay, cool. That's really helpful and great background.